Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, we're going to talk about some key documents, tax documents that your accountant is probably looking for this time of year. And also, there's still some time to do some year-end tax planning moves. And so that's what we're going to cover today. You can also find this information on our blog post, which has more details, which we won't get into all of them today, but some of them. As a brief legal disclaimer, our discussions here should not be construed as financial or investment advice, and especially today, not formal tax advice. And each person's situation is unique. All right, let's go. Well, today I'm joined again by Allie. Thanks for joining me, Allie.
Yeah, second podcast.
Second,
I'm a veteran now.
That's right. Yeah. Nothing that says let's have some fun with podcasts and talking taxes again. So, in fact, I think last time we talked taxes, it was year-end tax planning.
That's right.
Moves. Yeah. So kind of related, but more tax planning stuff.
Tax planning. Yep.
Yeah. So we're going to get into it. We're going to make people tell them why it's important, because there are some important things they can do at this time of year.
Yeah, I think a lot of people don't realize that you can still do things now for 2025. So.
Yeah. So we're recording this on Wednesday, February 25th. So you still have time, April 15th. I'm not sure if it falls in the weekend, but still time to take some action. But before we get into some of those details and the things you've been working on a lot, what I thought I'd do is give our viewers a quick overview of the blog post and a couple of things of why this is going to be important to you. If you look at my screen now, you'll see a table, and it shows different types of income. And so I won't get into all the details right now, but the main focus is the first two sections that you see there are going to be income types that impact ordinary income. And so that's what's going to, when we talk about deductions today, that's going to be able to lower that. So if you look at that, you can see what we're talking about today. We'll later get into tax forms, and so I won't bore you with that right now. And then the other thing, once you have this taxable income, you got to run through some deductions. And so again, we'll talk about some of those deductions, and then you end up with taxable income. And again, users may be thinking, well, what's the big deal, Kirk? So on the screen now, you're going to see the marginal tax rates. And we have it broken out by married filing joint and then single filer. The key thing is look at the middle column there. It says tax rate or RT, but that's your marginal tax rate. So when Allie and I talk about things that we can do to lower your ordinary income, it's going to be worth that much. And we're talking about just federal tax rates right here. So the state tax rates may apply, but we're going to focus on federal taxes. So anyway, hopefully I have your attention at this point of why it matters. You can see that maybe you're in the 22 or 24, maybe even 32 or higher. So when we talk about these tax things you can do, it's going to save you that much money just at the federal level alone. So that's why hopefully I got your attention. And so now let's talk about maybe, okay, they're excited. They want to listen. What can they do, Allie? So why don't we give them some ideas of what they still can do to impact those.
I kind of thought I would at least go over the four common ones that we kind of help clients with out this time of year. And like Kirk said, all these are helpful in reducing ordinary income. They may not all apply to you, but it's at least worth looking at to see because, they can save you some money. The first one is IRA contributions. Mm-hmm. As long as you have compensation income, you are eligible to make an IRA contribution. A lot of times clients, wonder if like unemployment or Social Security or pension or annuity income counts. Unfortunately, it does not. When we talk about compensation income, it's like your W-2 income or if you are a consulting income. The blog post that Kirk referenced has a table that describes, different types. So we're talking here about compensation income. Another kind of surprising thing that some clients don't realize is if you are married and you have a spouse that, maybe stays home or doesn't have any, little to no income, they can actually use their spouse's income to count towards that compensation income and make what's called a spousal IRA contribution. Another way for both people to, be able to contribute to IRAs. So if you, have that compensation income, you then can, look at to see, can I make a Roth IRA contribution, traditional, deductible, or a non-deductible? Depending on certain, where you fall with income limits determines which type you're able to make. So it's worth looking at, your modified adjusted gross income to see, which one you're eligible for. For clients that do those non-deductible traditional IRAs, a strategy that we commonly help people with is this backdoor Roth strategy that you have to be a little careful with because there's certain rules that apply. But that is one that, a lot of clients who necessarily weren't eligible to go directly into a Roth, it's a way to, get money into that Roth kind of, through the back doorway.
Mm-hmm. And that's all, it's a practice that is blessed by the IRS. It's not like it's a backdoor, like it's not a sneaky tax move. It's a legitimate.
It's a legit tax move, but it's just a indirect way, to get in. So once you kind of determine which type you're eligible for, the max for 2025 is $7,000. If you're over 50, you can actually do an extra $1,000. If you aren't sure, that's right. If you aren't sure which, how much you've done for the year, the form actually, so right now you're probably getting a lot of tax forms in the mail, and the tax form for IRA contributions actually doesn't come out till after the tax filing deadline. So, and that's because you can make contributions up until the tax filing deadline. So if you are looking to see how much you've done, usually we point clients to custodian statements. You can look at your year-end statement to see if you made, any contributions for 2025 last year. And then if you've done, maybe you did one in January, you could pull your most recent monthly statement for this year. Another kind of, thing to look out for that we've noticed with some clients that have like monthly contributions set up is, say they started it last year and they were hoping that, the January, February, and March contribution for this year counts towards 2025. Sometimes those auto contributions don't get coded correctly. So it's worth looking to make sure whatever you've done for this year that you wanted to count for last year is coded correctly. So that's just another thing to kind of look out for. So another kind of tax move that we also look at with clients are HSA contributions. These you have to make sure you have a high deductible health plan. So if you don't have one of those, you aren't eligible to do an HSA contribution. But the great thing about these is, unlike the IRAs, there's no income limits for what you can deduct. So if you have a high deductible plan and make contributions, no matter what your income is, all of it is tax deductible, which is great. For singles, you can do up to $4,300. If you have a family plan, you can do $8,550. And, again, if you're older, this time it's 55, not 50.
Still good. Still good.
One of the benefits of aging, you can do an extra $1,000. So, again, if you have a plan, single family, look at your age, you can determine how much you can do when you are looking to see, okay, say you're contributing through your employer and you are totaling up like how much you've done. When looking at those totals, make sure lots of times employers also contribute, may kick in a little extra. That does count towards those limits that we talked about. So it's not, say you're a single 4,300 plus employer, that employer piece counts. So say you're looking at all that and you're like, darn, I'm, short, but I contributed through my employer. Like, how do I get it into an HSA? Is it too late? It's not. You can actually contribute just directly into the HSA. So that's a kind of a way to, catch up, before the tax filing deadline, if you wanted to contribute more to that. Yeah. One other thing that, clients can take a look at are 529 contributions. Most plans actually have a 12/31 deadline, but there are a few states that do allow for contributions up into the tax filing deadline. We have those listed on our website. I think actually even in your blog, you listed a few. So it's worth checking to see, what the deadline is for your specific state plan. And if you, again, wanted to make more contributions and your state, had that later deadline, you can still, do those.
A quick clarification there. So I mentioned at the beginning, most of this is federal tax discussion. That's definitely a state-specific tax.
Correct.
And just for clarity, there is no federal deduction for 529. It's just a state deduction only for those plans. So
correct. Yes.
Still valuable. It's definitely worth looking.
Oh, for sure.
Yeah.
So especially depending on your state rate.
Yep.
And lastly, if you are a business owner and have a retirement plan, you have different deadlines and rules, and a lot of those still allow for contributions up into the specific plan tax filing deadline.
Mm-hmm.
So those can be a little more complicated and can have different rules. So it's worth talking to a professional about what your certain plan rules are. But those again are other plans that allow for later contributions.
And you mentioned the spousal IRA. That's a good reminder, because sometimes you forget about that, but people can make use of those. And oftentimes too, if a spouse hasn't been doing it, it works very well with backdoor Roths as well. So
exactly.
Again, we won't get into the details of it, but if a person doesn't have an IRA, the spousal IRA ability, it can be a great way that they definitely qualify for those different rules for the backdoor Roth.
For sure. Another question sometimes we get is, well, I've been contributing to my 401k and I maxed that out. Like, am I still able to do an IRA? And yes, you are. So that's another question that comes up sometimes.
Yeah, right. So you have a lot of complications there. So definitely, if you're into that kind of thing, go deep, read the rules, and be careful. Allie mentioned those contribution limits, and so that's actually things to look at as well. Or, if not, reach out to your financial advisor. Just make sure that they go deep on tax planning. Clearly we do. As we're talking, we go very deep on tax planning. So find one who does, because there's a lot of value to be picked up with these things. Reach out for help if you need it. We're here to help. There are a few more other things that's keeping us all busy in the office these days, and that is answering questions on tax forms that people may be asking about as they're preparing them for their accountant. And so I thought I'd go through a couple of key forms. Again, there's a full list of key ones anyway on our blog post. So take a look at them. I'm sure you've been getting them as you've been going along. But a couple of key ones that are very important, things to watch out for, or some common questions that we get from clients. And so I'm just referencing my list here. So the first one to be aware of is your W-2. So, Allie was talking about the different deductions, and it may or may not be deductible. HSAs are, and you may be thinking, cool, I got a 401k doing the traditional HSAs. Where's that out of my W-2 so I can make sure I get that deduction? The good news is it's already taken care of for you. So the wages that they show on your W-2 is already net of any deductible things you've been doing through your employer. So nothing to worry about it there. The other big one, though, is going to be the 1099-R. So I guess the R stands for retirement accounts. There's also a 1099-SA for HSAs. IRS gets very clever with their lettering here. So again, read through it. We won't go into the details, but a couple of things to watch out for. One, if you're doing if you're taking withdrawals out, that's what it's going to show up on there. And it has the gross amount in one box, and then it shows the taxable amount in the others. Depending upon, like Allie mentioned, those backdoor Roth conversions. Again, we can help people with those details, but it's going to show it as a taxable amount. But whether that applies as taxable or not is going to depend upon your situation. And get to know and love Form 8606, either you or your accountant. And even if your accountant is doing it, check, because we've seen more than a few that they're missing some on the 8606. So take a look at that. That's one thing to be aware of on the R's anyway.
Yeah, I was going to say, and sometimes clients that are rolling over a 401k plan, say they change jobs and, roll over their old plan into their new, they will too get a 1099-R. And, sometimes
they freak out.
That can be alarming because
big
it's
numbers.
A balance, right. And you're thinking, oh my gosh, like I didn't realize I did a distribution. Mm-hmm. That, make sure your accountant's aware of all these moves you're making, but, don't freak out. That's just kind of part of the process. You'll get it as long as you deposited it into your new plan within that 60-day window.
Right.
It's not taxable, but you will get that 1099-R.
Yeah. Or even if it's doing a direct transfer, then it's like you never see it. It just kind of goes directly. But yeah, right. Either way, it's and actually that's a good point. Again, a lot of details, but on your 1099-Rs, if you flip it over to page 2 and you get your readers out, because it's small print, they have codes on there. So there's different numbers and different letters. They all mean different things. And so was it a direct transfer? Was it a withdrawal, RMD, et cetera, et cetera. So get to know and love your 1099-Rs. Don't freak out if you see a big number. The other thing too, for individuals who are over age 70, so 70 and a half, so the QCDs. So if you're doing a charitable distribution, like, well, hey, Kirk and Allie told me that it was going to not be taxable, you're going to get a 1099-R. It's going to say taxable amount. Again, don't freak out. There's going to be a code. Actually, no, let me come back to the code. You've got to keep track of what that amount was and tell your accountant. Otherwise, you just lost that benefit. So it's very important that individuals are aware of that and tell their accountant. I mentioned the code because it's optional in 2025. In fact, I was just checking some Schwab 1099Rs last night, lots of fun. And they have it's code Y. So if you did a QCD, there's supposed to be a code Y, but they're not using it yet. So it is optional. So if you read about something like, hey, not to worry, there's going to be a code this year, it's optional and not all custodians are doing it. So just be aware.
Yeah. Another Kirk mentioned, you get it to 90 for your HSA distributions as well.
Mm-hmm.
That's kind of another one like the QCDs where you need to keep track of what, expenses were qualified.
Oh, otherwise,
the same thing. It's just, it looks like a taxable distribution. Say you're doing TurboTax and you put those, HSA distributions in. If you don't, check the correct box or tell your accountant that those were qualified medical expenses, which then aren't taxable, otherwise it's going to count towards your taxable income.
Mm-hmm.
So it's important to keep track of those expenses and then also make sure when you're doing your taxes that distribution is reported properly.
Yep. Yeah. And 3 other quick forms, and we can wrap it up here. One, I guess I'll jump down to the one related to IRAs, and that is there's a form 5498. But as Ali mentioned, you don't get it until May.
Right.
Again, for the reason you stated, you can make these contributions up till April, and so they don't want to keep sending out new ones. And so that is a form that comes. You don't get it till later. Just use the advice that Ali said, which is just check your statements and go from there. Speaking of forms that you might get one and then another one and you get ticked off about it. That is the 1099 Div, Int, B, or altogether the composite or consolidated. So those should be out by now. Again, it's February 25th, but custodians can sometimes have 3 cycles. And so you may get one on the 6th of February, you get all excited, you do your tax return, and then you log in like, wait a minute, there's a new 1099. So one, recognize that they can change it. Things get complicated. So you may want to wait until at least the 2nd cycle. If you want to be super certain, wait till the 3rd, but some people can't do that. The other thing too, again, with tax planning. So if you find you have a large short-term capital gain, that's something you control. You're trading stuff before the end of the year. So take a look at it for those big numbers. And again, reach out for help if something looks surprising to you. Another gotcha sometimes on there is what they call, I think it's called non-covered. And so cost basis. And so you sell something for $20,000. If you paid $15,000 for it, your taxable gain is only $5,000. Hopefully you waited at least a year if you could, and that's going to be long term. But sometimes, like if they don't know what the cost basis is, they say, oh, it's not covered basis. We don't have it. So watch out for it. Don't just like take the statement and run with it because you may have overpaying capital gains.
Exactly.
Yeah. So, and then finally, I guess the last one, I'm a big crypto fan, even again, in light of these big sell-off that's going on right now, still remain bullish. But for those crypto investors, I guess 2 quick things. One, at the beginning of your tax return, it's going to ask you, or your accountant's going to ask you, did you buy or sell digital assets? That question is related to direct crypto, not ETFs that buy crypto. And so if the main thing you're doing is buying these new, Bitwise or whatever firm you're using, but Bitcoin, Ethereum, Solana, ETFs, you don't need to check that box. But if you have a Coinbase, a Kraken, a Anchorage Digital, if you buy crypto directly, you got to be very careful. So 1, check that box. The IRS is watching it these days. And 2, new this year in 2025, those crypto custodians are required to send out their 1099 version. They call it a 1099 DA for digital assets. And so look at it. There again, be very careful about the cost basis because you may have transferred it in. So anyway, just be aware of it. You do have to report gains on crypto as well. And so just watch out for it. Lots of other forms, lots of other details. Done with taxes, that's it, right? So
right.
Again, don't delay, right? So it's end of February here. Get your information together. And make sure you get the tax benefits. Again, the things that Ali mentioned, there's still time.
Yeah, exactly.
So definitely do that and get them in, and then also enjoy this extra sunshine after you're done with the taxes. You can go ride a bike late at night because it's staying later.
Longer days, gotta love that.
You're an early bird, right? So you like wake up early and exercise in the sunshine.
I am.
And you and Bree are just like these 5 and 6 a.m. exercise things. I've tried it like 5 or 10 times in my life, and I'm just not a morning exercise. Yeah. So anyway, do it where you do it. Enjoy the sunshine on either end, and that's a wrap on today's topic. Thanks a lot.
Thank you.
Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.